Good afternoon, everyone, and welcome to our webinar, Starting Your Corporate Wellness Program. My name is Amanda, and Larry Grugin will be your presenter today. I know this is a topic we've been hearing a lot of questions about, so don't worry if you don't catch everything. We're recording the webinar, and we'll email you the video and the slides after the webinar ends. Our next webinar is on August 30th at 1 p.m. Central Time, and we'll be covering HIPAA. We have a lot of HIPAA privacy, thank you. We have a lot of participants today, so I'll be keeping the conference on mute, but Larry will pause for questions periodically, and I'll unmute so that you can ask them. If you prefer, you can type them in the question box, and I'll ask the questions for you. Other than that, please enjoy.
Thank you very much, Amanda. I appreciate it. This area is becoming popular because of the fact that the EEOC just came out with regulations just a few months ago. We've been waiting for them for like 6-7 years. And many employers are considering wellness programs, especially if they have spikes in their health plan costs. The problem is going to be is how to start, how to organize it, and what are some of the legal requirements that you have to adhere to. And when I go through this for my clients, they're surprised about how many different laws affect wellness programs. So what I'm going to try to do is go through the various requirements and just make sure if you're considering a wellness program, these are things you have to really concern yourself with. So again, we're talking about the compliance issues under wellness programs. And these are all the requirements I'm going to be talking about today. There are HIPAA requirements. There's been various regulations on this. I'll go through this. There were regulations, I think, back in 2006, and then they were revised in 2013. And there were some changes in the final regulations when they came out with 2013. Requirements under the Internal Revenue Code. The IRS just came out with a release just a few weeks ago, and I'll be covering that. In some situations, you have to concern yourself with, well, whether the benefit given to the employees would be taxable. So what benefits are taxable, what benefits are taxable under a wellness program. Then under certain circumstances, you may have to consider whether your wellness program is subject to the requirements of ERISA, which means you may have to do a plan document, an SPD, consider all the requirements under ERISA, and if it's an ERISA benefit, then and it's a medical plan under ERISA, then you have to concern yourself with COBRA. So I'll be talking about that. In that area alone, it's not that sophisticated, and we're relying on just one release from the DOL. And then the two requirements that are just recently came out just a few months ago are the requirements under GINA and under the Americans with Disabilities Act. Now, what's interesting about those is that the requirements under those contradict some of the requirements under HIPAA on HIPAA regulations. And I'll be discussing exactly what the effect is. And then I'll be talking about the effect of wellness programs on the ACA. It affects costs, it affects various requirements. I'll be talking about, for example, if you have a wellness program and somebody qualifies for a wellness benefit, they get a discount, and then 1 year you don't qualify, and then all of a sudden now you blow grandfather status. Or it could affect, for example, the affordability requirements in order for an employer to avoid any penalties. So those are things you have to concern yourself with in deciding whether you're going to go with a wellness program. So let's look at, first of all, the requirements under HIPAA. Now, generally under HIPAA, and these are the non-discrimination requirements under HIPAA, not the privacy section, but the portability section, as this indicates that group health plans cannot discriminate against participants on the basis of health factors. So you cannot charge someone because they use the plan more. You can't affect eligibility. You can't affect the premiums. And basically, just because somebody has a certain condition, you cannot charge them more technically under HIPAA portability. So as this slide indicates, it affects eligibility, enrollment, effective date, waiting periods, benefits, and premiums. As I said before, you can't charge anyone more just because they use the plan. Or now, the only exception to that is if you meet the wellness regulations under the HIPAA rules. Then that's an exception. As long as you meet those rules, then it won't be considered to be you're violating the HIPAA portability rules. And this is important because violations of the HIPAA non-discrimination rules can result in, as this says, under the Internal Revenue Code, excise taxes of $100 a day, a DOL and audit and civil action to enforce rules, and then a private cause of action under ERISA 502. So it's not something to take lightly. And in what I've been hearing in the street, and this is over in the last year, the DOL, they're auditing plans for compliance with various laws, including ACA. So in the past, you never saw any compliance issues or any enforcement of rules. Now you're seeing the DOL go after employers in the health and welfare side as opposed to the 401k on the pension side. So that's something to really concern yourself with. So there were final regulations that came out in 2013. And under these regulations, there's two types of wellness programs. One is called the Health-Contingent Program. Provides a reward that is contingent or satisfaction of the health contingent standard. And in layman's English, what does that mean? It means that in order to get a benefit, you have to score at various levels on your health risk assessment. Your cholesterol has to be a certain level, and there's various other cholesterol, your blood pressure, and the employer can pick which ones. And if you meet those requirements, then you get some type of benefit under the wellness program. The other type of plan is called the participation-only program, and that's what many employers start out with. It's basically you get a reward by showing up, by taking the health risk assessment, by getting a physical. So that's the first step. The first step is getting because one thing that many employers are realizing, especially for many male employees, many male employees haven't had a physical for years. So what they're saying to these employees, all employees, if you get a physical, if you get a vision test, if you get certain tests done, we'll give you a benefit. We'll give you a discount. We'll give you a cash reward. We'll do something to encourage you to get these things done. Now, we're not going to base the reward on the results of any testing. All we want you to do is the first step is go out and do this. And after a few years of getting tests done, then the next step is the health contingent program saying, okay, if you want any more rewards, then we're going to base it on the results of that health risk assessment. So that's the next step. Now, what's interesting is the fact that under the HIPAA portability rules, there's 5 requirements for health contingent programs, and there's really no requirements on the participation-only program. So again, under the health contingent program, there's 5 specific conditions which I'll go through that you have to satisfy in order to be compliant under this. And again, the only requirement, as this slide indicates, for the participation-only programs is the fact that it's got to be available what we call similarly situated individuals, which means a location or a division. It can't just be, for example, for the executives. That's not going to fly under these rules. So there's all kinds of wellness programs. They take many forms. Some are very simple. Some are very sophisticated. What many employers do is that they give a reduced premium or copays in exchange for quitting smoking, reducing bad cholesterol levels, for example. And what these programs do is encourage healthier lifestyles. And this has been encouraged by the administration and by HHS and they are encouraging employers to consider providing health promotion and wellness programs and disease management programs as part of their health plans. And again, these wellness programs could be part of your medical program or a freestanding program. And in some of these programs are pretty simple. Others target individuals with specific medical conditions such as asthma, diabetes, making sure, for example, disease management could be part of your wellness program. So as this slide indicates, programs may provide case managers who will help monitor compliance with medication protocols, schedule appointments, make sure that these individuals, especially if they're taking multiple medications, that the doctors talk to each other. And again, the rewards under these programs can vary greatly by just sponsoring health fairs or events, providing T-shirts and water bottles, sponsoring, for example, fairs. But also what they'll do is they may give significant reductions in premiums, copays, and deductibles. And again, what you need to do in order to qualify can vary greatly. They may require an employee to actually quit smoking, lower cholesterol, or just, as I said before, merely take a test as the first step. Now, the key to all this is something called the health risk assessment. And these are used as a starting point for many wellness programs. This can be as sophisticated as a few tests, or it could be a full-blown physical exam. So as this slide indicates, HRAs also can be more hands-on and range from basic screenings at the employee's website, blood pressure, cholesterol, body mass index, blood sugar, bone density, to complete physicals at a doctor's office or at a hospital. I mean, many times employers start at something simple at their work site. But what's key to this is on the bottom of this slide, so once an initial HRA is used as a baseline against which subsequent assessments are measured. So you can use that first one as a way of measuring the progress of your employees to get healthy. But one thing is important, and all the governmental agencies have done this, have said this, that an employer cannot make taking an HRA, health risk assessment, mandatory receive coverage. Now, what you can do, if somebody doesn't want to take the test, you can penalize them by not giving a reduction or charging them more for coverage. So you can do it, but you cannot deny them coverage. And some employers get in trouble with the EEOC for doing this. Now, participation-based program, as I said before, you're not basing the eligibility for any benefits on meeting certain health standards. All you're basically doing is giving individuals specific programs, and they just basically either have to attend, take a test. So initiatives can include participation in a health flare or testing, waiver of copays and deductibles for baby visits, reimbursement for health club membership, reimbursements for smoking cessation program, and program that rewards employees who complete the health risk assessment. So basically, you just get a benefit for showing up or taking a test. Now, for the health contingent standards, they require, and these are more sophisticated, they require an employee to meet certain standards that are picked by you, the employer. So the reward includes both an incentive in the form of reward, premium discount, waiver of cost sharing, additional benefit. And there's two types of health contingent programs. As this seen in this slide, there's an activity-only program. And under these programs, employers may require employees to engage in activity, join a health club, walk, exercise, use weights. And these can be very simple by, having them walk a few miles a week or whatever, but I mean, it's activity-based, and they may include in that program a membership in a health club, and you have to go so many days a week and show you've done certain things. The more popular program program, when you go into the health contingent programs, are called outcome-based programs. Require individuals to obtain and maintain a specific health outcome. And for example, an employer could provide a reward for not smoking, for obtaining a certain result on their biometric screening, or obtaining a certain body mass index. So you, the employer, are going to, and with assistance probably from a wellness consultant, about what is feasible and what is, because it's embarrassing to set standards that nobody gets the benefit. So if you're going to have a health contingent program, there's basically going to be 5 different requirements, as I indicated before, that you have to meet in order to be compliant and not to be in violation of the HIPAA portability rules, non-discrimination requirements. And those are, and I'll explain each one. Reward must not be more than 30% of the cost of coverage. The program must be reasonably designed to promote health and prevent disease. The program must give individuals an opportunity to qualify for at least a reward at least once a year. It must be available to all similarly situated individuals. I'm explaining what that is. And the plan must disclose that alternative health contingencies or waivers are available. So these are the 5 requirements you have to meet in order to be a compliant program. Now, first of all, 30% of the cost of coverage, what does that mean? Basically, whoever is involved with the program under these rules, it's the premium. So if you just have employees participating in the program, it's 30% of the single premium, both the employee piece and the employer piece. Now, if you're going to have smoking cessation programs, that will increase to 50%. So the reward can be seen as a form of a discount or a rebate of the premium. Some employers actually increase the cost of coverage, but you can also have discounts and deductibles, co-pays, co-insurance, an absence of a surcharge, whatever you think will encourage employees to participate. But again, no reward can be higher than 30% of the premium. Now again, as I said, if only the employee is participating, it's 30% of the single rate. The program must be reasonably designed to promote health. And it meets that if it has a reasonable chance of improving health or preventing disease, it's not overly burdensome, it's not a subterfuge for discriminating based on a health factor, and it's not highly suspect in the method chosen to promote health, prevent disease. Now, what are they getting at here? What are they doing here? What they don't want programs to do is design a program, for example, for cancer disease management, and oh, by the way, 2 executives at the company have cancer, and so they get the rewards for managing their condition. So they don't want that program just to be designed for a few individuals and give them a discount to circumvent all the other employees. Now, the program, and again, there is no need to be scientific. There are examples in the final regulations. Basically, the more broad-based your programs are, where you have general health conditions, fight obesity, smoking, that type of thing, high cholesterol, those programs are examples in the regulations that will probably satisfy this requirement and be seen as designed to promote health and prevent disease. But the determination of whether that program meets their requirement will be based on all relevant facts and circumstances. Now, again, in that situation, what you have to do is that they must be able to qualify for that discount at least once a year. Now, you could be more generous and do it more times a year, every 6 months, but at least once a year. And many employers key it off of their annual enrollment that show evidence the fact that you meet these requirements, and that annual enrollment will give you a discount. Now, it could be completing a smoking cessation program, and once the smoking cessation program is completed, then you get the discount. So you have to do that. And similarly situated, what this slide is trying to say is that you don't have to include everyone in your program. You could have a program that's, for example, you have a program at one location with smoking. So you have a smoking cessation program at one of your locations to meet that requirement. Another location, you have many people that have weight problems, obese. So you have another program at that location. So you can vary your programs depending on what the need is and what you're going to do, and so that program doesn't have to include everyone. And you could include, for example, in individuals in a bona fide employment classification, full-time versus part-time, various geographic locations, you could do that. So the reward can be offered to a group of employees in one location, but another location. So, and this is important. So you can target exactly which programs will go to which location depending on what the need is. So you can, for example, as this slide indicates, you can provide the reward only to employees and not to spouses or dependent children. And again, it's up to you who you want to target. Now, for activity-based programs, as this slide indicates, the reward is not available to all assemblies unless the program allows, and this is important, both for the outcomes-based and activities-based. What you have to do, if somebody cannot meet the standard, what is required, and this is the hardest part of these requirements, you have to come up with a reasonable alternative so they can qualify for the reward. Somebody comes to you and says, I cannot walk that much, I need something else to do. So you as an employer, for them to meet that requirement, especially the activities-based program, come up with something else they could do in order to meet the requirement. You know, I have trouble walking, could I do something else? Okay, if you can't walk, can you swim? Go to the gym and swim, and then we'll give you the reward. So again, the activity-only programs are permissible for a plan to require verification, such as a statement from the personal physician that the individual in such health condition, but only if it's reasonable under the circumstances.
Larry?
And it's also reasonable to require verification if the medical judgment is required to evaluate the validity of the requested alternative standard.
Larry, I need to interrupt you for just a second.
Sure.
Could anybody in chat indicate if they're having trouble with the dial-in audio? We have one complaint, and I'm just trying to figure out if it's a problem on their end or on ours.
Okay.
Okay, it looks like we're good on audio for most people, so I will let them know.
Okay, all right.
Sorry about that. Please continue.
I'll be done with this section in a few minutes. We can
Great.
stop for questions. So I'm almost done with this section. Same thing with outcomes-based programs. What's important here, and the hardest thing that many employers are dealing with, if, for example, for our outcomes-based program, you have a program that says you have to quit smoking, and quit smoking for a period of time, 6 months, before you get the reward. Somebody comes to you and said, well, I cannot quit smoking. My doctor says I'm highly addicted, and can I do something else to qualify? So basically what you do in that circumstance is that you tell them, okay, you have to take a smoking cessation program, and once you complete the smoking cessation program, then you can get the discount. So you don't have to quit smoking, you just have to attend the smoking cessation program. Another example of somebody you have as part of your wellness program is you have to have a cholesterol level at a certain level. Somebody comes to you and said, well, I have a family history of high cholesterol, but I'm managing it, I'm taking my medicine. Here's a note from my doctor indicating that that's my problem. And you can say, okay, as long as you take your medication, as long as you see your doctor, and your cholesterol doesn't increase, then you'll get a discount. So again, you as an employer, and what's interesting, in the regulations, there's no specified alternative standard. You as an employer have to come up with those standards so somebody can, again, meet that requirement that you've set and as an alternative and qualify for the reward. So again, an individual must be given an opportunity to comply with the recommendations of of the individual's personal physician is a second reasonable alternative standard to meet the reasonable alternative standard defined under the plan. So you can work with the doctor in order to come up with a reasonable standard. Now, again, under the outcomes-based program, it's not reasonable to require verification that the health factor is unreasonably difficult or medically inadvisable. But again, if it's activity-based, it may seek verification, for example, for activity-based so the person doesn't get injured or have further health problems. Now, determination of whether a plan has a reasonable alternative is based on all facts and circumstances. And the following factors, among others, should be taken into account in determining whether the plan has provided a reasonable alternative. If a reasonable alternative is the completion of the educational program, the plan must make that educational program available or assist the employee in finding a program. The time commitment must be reasonable. And if reasonably alternative standard is a diet program, the plan is not required to pay the cost of food, but must pay for the membership. And the individual's personal physician states that any plan standard, including recommendations of the plan's medical professional, is not medically appropriate for that individual, plan must provide a reasonable alternative that accommodates the recommendations of the individual's personal physician. So again, this is the hardest part that many employers are grappling with in trying to decide exactly what a reasonable alternative standard is. Now again, as an alternative, what the employer can do is waive the standard. They can't find anything that will meet a reasonable standard for that individual, so they may just say, okay, we'll just waive it and you can qualify. Reasonable alternative standards may be provided for a class of employers or an individual by individual basis. And the full reward, either an activity-based or outcomes-based, must be available to all similarly situated individuals. And individuals who qualify for satisfying the reasonable alternative must be provided the same full reward. And again, you have to give, at the last bullet on that page, you have to give individuals time to complete the reasonable alternative standard. Now, it's not required that you publicize all these different alternatives. Basically, what this slide is trying to say is that you have to indicate to the employees, if you don't otherwise qualify, there is a reasonable alternative standard available without indicating what that is. Just the fact that it's available. And that's what this slide is trying to say. Are there any questions?
Yeah, so we had...
Amanda, do you have any questions?
Yeah, so we had a really great one in chat, which was in regards to the 30% cost of the employee-only coverage, is the 30% of the full premium or only 30% of the employee portion of the health premium?
It's the full premium.
Great. All right, and I'm going to open up questions to everybody else.
The conference has been unmuted.
Does anybody have any questions or comments or anybody?
So if you had a family premium, it would be 30% of the higher family premium as well?
Well, here's the issue and here's the problem. The problem with that is the EEOC says, no, you can only take the individual premium. I'm going to get that in a few minutes. So the EEOC just came out a few months ago and said, no, in order to meet the requirements of ADA, you can only take 30% of the single premium. So under HIPAA, that's one of the contradictions. Under the HIPAA regs, it says 30% of the full premium. So if you had a whole family that was participating under the wellness program, you could do that. The EEOC came back and said, no, that's a violation of ADA, and therefore you can only base it on 30% of the single premium. I'll be covering that in the next few minutes.
Thank you.
Did we have any other questions?
Any other questions? So the hardest part of all the requirements I just went through that many employers are dealing with is coming up with reasonable alternatives that an employee comes to you and said, I can't walk the distance you indicated in your requirement. I can't quit smoking. do you have something else that I can do in order to qualify for that discount? And that's what your challenge is going to be. That's what your HR department has to deal with, is the fact that, and as the program indicated, or as the requirements indicated, you can have individual by individual alternative standards that you have to come up with. Any other questions? All right, let's continue.
All right.
And the other requirement that you have to meet
Just 1 second.
is the fact that
The
you
conference
have
has
to,
been muted.
you have to make sure whether that benefit that you give to the employee will be taxable. And that's, especially some employers come up with very, very detailed and very varied programs. And we have to go through it to make sure that there's no tax issues. So here are the rules. And again, just a few months ago, the IRS came up with a memorandum 2016-22031 that basically indicated. Now, basically what they've said in the past, a wellness benefit does not qualify as either an eligible medical expense under Code Section 213D or fringe benefit under 132, it's going to be taxable to the employee. Now, what does that mean in layman's language? It means that if you give an employee, for example, $100 to take a health risk assessment, technically that $100 would be taxable. 2, if you sponsor a wellness fair and you give T-shirts and you give water bottles, that's called a de minimis fringe, and therefore it would not be taxable to the employee. Thirdly, if you say to the employees, we've just signed you up for a membership at the local health club, and the premium and the cost for the coverage is $50 a month, and we're going to give that to you as a benefit, that health club membership would be taxable to the employee. So again, cash and non-cash incentives, payments, and rewards paid to the employer are not excludable from the employee's taxable income merely because they're paid under a wellness program. So cash payments, even in such small amounts of $10 or $25 for participating in a program, are taxable. Non-cash rewards, incentives, and other programs that are not medical care, for example, payment of a gym membership, unless, for example, somebody is obese and they're directed to join a membership, would be taxable. Now, what they've also said in this memorandum, there's certain things that are excludable. Benefit services, non-cash rewards, incentives that are medical care would be non-taxable. So if you gave a discount, for example, to employees for participating, that discount would not be taxable. But if you give cash or cash equivalents such as gift cards, those gift cards that the IRS has said are considered cash and would be taxable to the employees. Also, as part of the wellness programs, they qualify for HSA contributions by the employer, as this slide indicates. Those contributions would not be taxable. So you have to be careful in designing your program. And if you give cash to the employees, generally that cash would be taxable. If you give discounts in deductibles, co-pays, co-insurance, those would not be taxable. ERISA. This is important because if you have a very sophisticated wellness program, and you have disease management, you have various testing in your wellness program, what the DOL has indicated is that would be considered to be an ERISA benefit program. Now, this is important because if it's an ERISA plan, it's considered a group health plan under ERISA, then again, what the problem is, COBRA would apply, and all the different ERISA requirements apply. Now, the problem with this is this stance the DOL is taking is based on a letter to a Joseph Dunn in 1993, and the DOL indicated that wellness program would be considered providing medical care if it provides programs that are diagnostic or preventive, or that coach for certain identified health risk factors. So generally, if you have a participatory wellness program that will not meet that requirement, but if you have an outcomes-based program where certain testing is done, or you have a program with disease management in it, then that would be considered to be again, a ERISA medical plan, because it's providing medical care. So let's go into the wonderful world of GINA, genetic testing. So underwriting purposes include deductibles and other cost-sharing mechanisms. One thing a wellness program cannot do, and it's a violation of GINA, family history, any genetic information can be collected for the purpose of such collection is neither for underwriting or not prior to in connection with enrollment. Genetic information includes the collection of any family history. So as this slide indicates, any wellness program that provides rewards for completing HRAs that include genetic information, that violates the prohibition against requesting genetic information. This is the result even if the rewards are not based on the outcome of the assessment. But if you're doing any collection of family history, that is seen as a violation. So genetic information can be collected as long as no rewards are provided, and a group health plan can provide rewards for completing an HRA as long as no genetic information is collected. Now, in May 2016, the EEOC released regulations on how GINA can affect wellness programs. And what they indicate is an employer offering an incentive to an employee for an employee's spouse to complete an HRA or biometric screening must obtain a voluntary written authorization from the spouse. And the written authorization must describe the type of genetic information that will be obtained and how it will be used, and confidentially protections and safe transfer and disclosure. Also, both on the ADA side, on the GINA side, you cannot prohibit someone from participating in a health plan just because they're not participating in the wellness program. So an employer is prohibited from restricting access to particular benefits based on an employee or his or her family members or the spouse's refusal to provide information. And some employers are doing this. They're saying, we offer 3 plans, and if you don't participate in the wellness program, we're going to deny you participation in 2. You only get one of the plans. And clearly the EEOC said under these regulations you cannot do that. So you cannot prohibit someone from participating in a plan just because they don't. And also incentives for child participation is prohibited. Incentives for information from a child of an employee is prohibited. And the prohibition applies to both minor and adult children. Separate incentives for employees and spouses. The EEOC does not consider a wellness program to meet the reasonable design requirement if it penalizes an employee due to the spouse's failure to participate or achieve a particular area, so you can't penalize an employee. And plans with a spousal participation component must be designed in a way that the employee may still receive its own reward if the spouse is not participating. And also, as I said before, this is a direct contradiction to the HIPAA rules. Incentives are limited to 30% of the self-only coverage. So again, this contradicts what the HIPAA regs said. Now, these regs are not effective now. They're not effective until the first plan year beginning on or after January 2017. And again, these are final regulations, so they're not effective now. Let's look at ADA. Again, also ADA makes it very clear that you cannot prohibit or deny access to a benefit program just because someone is not participating in a wellness program. Also, in this situation, there are two rules under ADA that employers offering wellness program. First, ADA prohibits employment discrimination against disabled individuals, and wellness and disease management programs that require disabled individuals to participate to obtain benefits equal to those for non-disabled individuals must be found to violate this provision. Secondly, ADA limits the circumstances under which an employer may require employees to undergo physical exams or provide answers to medical inquiries. And this prohibition on medical exams or inquiries is subject to some exceptions, including an exception that permits employers to conduct voluntary medical exams and inquiries as part of a health program, a wellness program. So this is the exception. Also, if you, again, have a wellness program, there's a new notice requirement under the EEOC. So for a wellness program to be considered voluntary, and employers must meet certain conditions. One of these conditions is that a new notice requirement. Employees participating in a wellness programs that involve disease-related inquiries or medical exams must be given a notice that describes the type of information to be collected, the purpose of what that information will be used, the restrictions on disclosure of the information, any employer representatives or parties with whom the information will be shared, and the message used to ensure the information will not be improperly disclosed. Now, the EEOC did release a model notice that you can use, so that there is a model notice out there. And again, like the GINA restrictions on the EEOC, they indicated for ADA purposes, the final retains the 30% cap, but clarifies how the limitation will be calculated. The calculations method is addressed this. So incentives provided to employees when participation in the wellness program is limited to those enrolled in the plan. Incentives provided to employees when the employer offers only one plan is for that one plan. It's 30% of the single coverage. And incentives provided to employees that does not offer programs is limited to a certain amount. Again, under the EEOC, the program will be subject to the total incentive cap of 30%. So again, if you have a wellness program, somebody doesn't participate under the medical program, any reward would be limited to 30% of your cheapest plan. So again, that's how it's indicated. And a wellness program that merely asks an employee whether or not they use tobacco is not subject to the 30% requirement. They're subject to the 50% requirement. If they test for nicotine, then that limit is not 50%, it drops down to the 30%. Also, confidentiality, this is extremely important for the EEOC. All the HIPAA privacy rules must be met. This information must be protected. That's what this slide indicates. So under the EEOC, it's likely that wellness programs must comply with HIPAA privacy. So you have to have a wall between this information and the employer in order to be compliant. You have to be very careful about the results of these wellness examinations, who they go to at the employer, if at all. So again, you have to be extremely, extremely careful about who sees this wellness information. And again, just like under GINA, this information is effective for plan years beginning on or after January 1st, 2017. All right, how are wellness programs received under ACA? Well, you have to be careful with grandfather status. As I indicated in the very beginning, if you have somebody in 1 year that qualifies for the discount, gets the discount, and the next year doesn't qualify, then you basically may have blown your grandfather status, because in this situation, the employer contributions cannot vary by 5 percentage points from the contribution rate as of March 23rd, 2010. So you have to be very careful and how that affects your grandfather status. On the employer mandate, remember that there's an affordability rule, and for this requirement for affordability, for the 30% requirement, basically what they said for the affordability rule, which we treat as if everybody fails the requirement and you use the higher rate. For the smoking cessation program, we assume everybody qualifies and you use the lower rate. So again, extremely important to understand that. So these are the areas that are affected under ACA for wellness programs. Amanda, are there any other questions?
Yes. We have two. If we have multiple programs available, such as outcomes-based screenings, quarterly initiatives like walking programs...
Amanda?
Oh, sorry about that. I was talking and didn't realize I was muted. If we have multiple programs available, such as outcomes-based screenings, quarterly initiatives like walking programs, do we need to combine the value of all of these programs?
Yes.
Okay. And the other question was, regarding the reward being limited to the cheapest plan, does that mean if a PPO and an HDHP...
That's only if that person's not participating, if they're participating under one particular plan to use that plan.
Okay.
I just said that if that person, for example, is an employee and said, I want to participate, but I'm in my wife's plan.
Okay.
Then what plan do you use? And they say use the cheapest plan.
Okay. So even if it's a high deductible plan, if they're not participating
Correct.
in health insurance, it would be that one.
So if you have three plans and one of them is a PPO and they're participating in the PPO, it's the plan they're participating under. But if they're not participating under any of the plans and they still want to participate, use the cheapest plan.
Okay, and now I'll open it up to questions from everybody.
The conference has been unmuted.
Does anybody have any questions? Anybody? Oh, come on. Yes. Anybody have any questions?
Yes.
Mm-hmm.
If you have a plan where you're offering different incentives based off of the department, what happens if individuals transfer from one department to another department, another region, or another office to a different office? What happens at that point?
You just apply the new standards. I mean, you can have various programs in various locations.
Oh, that's what I was at. Okay.
Yeah, and so it could vary with location, or it could vary. For example, you have a program that you have one program for salary, one program for hourly, and they transfer from one group to the other, then their incentives would change.
Okay.
All right?
Thank you. Mm-hmm.
Any other questions?
We have a couple more. What about,
Okay.
I want to offer telemedicine for free to my high deductible plan enrollees. Is this allowed?
The problem with it is under certain conditions, and I'm going to be coming out with this, something on this in the next few weeks. In some situations, not all, in some situations, if it's a robust telemedicine program and the employer is paying for the program, it could affect your eligibility for an HSA. Not in all situations, but in some. Now, the best way to avoid any problems with that is if you have a value for that visit, let's say $40 or $20, that's the cost of the program. Charge that employee for the cost because there can't be any coverage below the high deductible. So again, it's a little more complicated than what I've just indicated, but in many situations, participation in a telemedicine program may affect your eligibility for HSAs.
Okay. And then, if only one participant is chosen as a winner, like a prize of $50 of a program, would that value be used across the board for part of the value?
I would think it would. In some situations, it's not seen as a taxable incentive. I would have to look at the situation and look at the requirements to see if it would be taxable or not.
Okay, would that count towards the 30% for everybody, or just for the person who received it?
Just the person who received it.
Okay, interesting.
Now again, what many employers do, and you have to be very careful in that, what many employers do on the wellness programs, they give employees gift cards. And the problem with a gift card is if it can be redeemable in cash, it's seen as cash to the IRS, and it should be taxable. And this is one area that the IRS and DOL are looking at, violations. So please be very careful in this area.
I have a question on that. What if the health insurance company, we offer the health insurance company's wellness program, and if an employee obtains so many points, then the health insurance company issues a $100 gift card?
If that gift card can be redeemable in cash, it's seen as cash and has to be taxable. Then, if you Google gift cards and taxable, you're going to see the IRS guidance on this. They're very not very big on gift cards. Are there any other questions? Well, thank you, everybody. Again, if you want to, this will be up in a few days if you want to look at it again. And I appreciate it. Thank you very much. Amanda, thank you.
Thank you. It'll actually be up in just about an hour, and we'll be emailing it to everybody.
Okay. Thank you. Bye-bye.
Bye.